In keeping with what I believe is IGCC tradition, we're going to try to end on a positive note today, and put aside for the time being all the complexities of how to manage the downside risk and how to assess that in your portfolios, and talk further about the scale of the investment needed, but more importantly, what's possible, how could we invest further, faster. In this session, so remembering as well that I think we all share a broader responsibility, or sorry, a broader interest, I should say, arguably a responsibility in terms of, a broader financial interest in positive investing, because it helps us all manage broader system risk, broader economic financial system risk. It's also arguably a degree of sort of protection against sudden changes in market sentiment that could cause, well, changes in market sentiment that could lead to sudden asset revaluations in the market. So there is this systemic risk dimension that I do think is important to consider as well, and it can lead to a view that it's not, where win-win solutions are not always possible, the systemic risk dimension might be at least a qualitative factor that makes you pause and look a bit harder at a positive investment opportunity. And I think that's very much the way things are going in the corporate sustainability sort of context. So I think we perhaps have some lessons that we can take from that context as well. So the topic of this session is investing for the transition to a net zero economy. I think you're probably all familiar that stems from the Paris Agreement. So the goals are to broadly to reach net zero emissions by 2050, and that will require a peaking of emissions by 2020 or thereabouts. So in practical terms, we're going to look at what does this actually mean, and what will it require, and are we on track? And based on, I think, what we've heard over the last few days, and I'm not going to try to sum up the whole conference, I think Emma's going to do a fantastic job, and a much better job than I could do afterwards, but based on what I've heard over the last few days, I think the gist of it is we're sort of moving slowly in the right direction, or some countries are, but not enough, not fast enough at all. We know that success in meeting these goals hinges on energy sector transformation, but that's not the only place we should be looking for opportunity. In Australia, there's been a lot of discussion about the politics and the policy framework here, and the disconnect arguably between Australia's international pledges and the domestic policy, and the disconnect between what business and stakeholders want and what the politicians are doing. I'd also like to place this discussion in the context of Mission 2020, and for those who are not familiar with this, it's an initiative that was spearheaded by the former UNFCCC Executive Secretary, Christiana Figueres, and she is trying to drive home the message of the critical urgency of peaking emissions at 2020, otherwise we could sort of reach a tipping point and lose any sort of real prospect of hitting the 2 degrees goal. And she sets out, well, that initiative sets out some tangible, very specific targets for different sectors, and for finance in particular, just sort of gives you a sense of the scale of investment that would be needed, and that's up to $1 billion. Was it $1 billion? Up to 100 billion every year. So that's the scale of the opportunity. Is a more positive way to look at it. For those of you who were at PRI last month, Christiana Figueres made a call to action to institutional investors to allocate up to 1% of their funds to clean investment. Now, whatever you think of that as a mechanism, I think the point is whether it's through a dedicated allocation or whether it's through other measures. How do we respond? How could we respond to these challenges? And finally, for those who are able to attend the gala dinner last night, I think it was just a really sobering reminder from the Admiral Chris Barry about the existential threat that we face, and as he put it, we just can't afford not to act. So coming back to how is this possible, what could we do? IGCC published a piece of research recently and it entitled The Road to Return, and it, I won't go into the details of the findings, but broadly speaking, there's a strong appetite across Australian and New Zealand investors for green investment, but a reluctance to publish targets at this stage, and that's due to a number of factors, but I think the most prominent one that came out in the survey with members and investors is a lack of investable deals, offering an appropriate risk-return profile, and that's largely a big factor there is future policy uncertainty. So where there might be short-term sort of fundamentals, the short-term fundamentals might look like they stack up, the long-term picture is, with policy is still deterring investors. So I'm going to introduce the panel in a moment and ask them to speak to the question of, how could we meet the challenge from a technology and financing perspective? How could it be possible? And try not to have a rehash of all the barriers that we're sort of all very familiar with, but to the extent that we talk about those, really try to drill down into what's really at the heart of it and what are some practical things that we could actually do to address those things, right now. So we have a fantastic panel that's able to look at these questions across the capital chain. We can talk about public and private market opportunities, look at particularly at the energy sector, but also at other sectors, emerging products and tools that are accessible to us right now. So our first panellist is Leonard Kwong from Bloomberg New Energy Finance, and he's going to talk about the macro level picture on future electricity generation mix in Australia and across the Asia Pacific region. And Richard Lovell from Clean Energy Finance Corporation, he's going to talk about where they see the opportunity more broadly in Australia and how they are stepping in to address the market failures that are still impeding greater private sector investment. And then we have Michael Correa from Westpac Institutional Bank. He's Head of Corporate and Institutional Origination and Distribution, Financial Markets. That's a really big title. How do you get that on your business card? And Michael Salvatico, who I'm sure many of you are familiar with, Executive Director ESG Research at MSCI. And both Michaels will cover a lot of stuff, I'm sure, but I'm hoping they'll touch on how they're integrating climate change risk and opportunity into their analysis and investment decision making and product design, and their experience to date and what products and tools are available and what they're using.
Thanks, Justine, for the warm welcome, and to IGCC for organising such a fantastic summit. I might throw the clip. Thank you. So, as Justine mentioned, my name is Leonard Kwong. I'm an analyst with Bloomberg New Energy Finance. And for those of you who aren't familiar with Bloomberg New Energy Finance, we're an independent research firm acquired in 2009 by Bloomberg, who I'm sure most of you are familiar with, as a bet on the US carbon market, which just turned out fantastically for them. But we've stayed around and we've grown, and we now have over 300 analysts in every major energy market around the world. And our new mandate is to really focus on the transitioning energy sector. So we have specialists in all sorts of categories and geographical regions. And today, the real purpose of my presentation is to outline some of the big key findings that we found in terms of the opportunity for investment, specifically looking within the APAC region. Now, I know I hold the fairly dubious position of being the first speaker on the last panel on a fairly long and interesting day, so I can't promise any good jokes or pictures of fields of wheat, but I will have nice, pretty charts with bright, bold colours to hopefully keep your attention for a bit longer. So this is our view on how the energy market throughout APAC will transition between now and 2040. Excuse me. So this is produced as a result of our yearly publication called the New Energy Outlook, which we should really dive into what it is and what it isn't. So this is not a wish list for the industry or for the market, and it's certainly not a policy manifesto for politicians around the region. This is combining a bottom-up view on the fundamentals of technology costs and consumer behaviour with a top-down perspective on what's happening with demand and the energy system. So a few key messages, and I'm going to start with the findings first and work my way through the fundamentals a bit later on. But from the immediate onset, you can see that over the forecast period between now and 2040, we expect the energy system around APAC to at least double in size. Around 5,000 gigawatts of new capacity, generation capacity, will be built. Around 61% of that will be in zero emissions technologies. Now, the two key messages that we see emerging within the timeframes is first, the continual reductions in renewable energy costs will start to suppress the expansion of the need for coal for electrification and for new demand around the early 2020s. Beyond that, we can see that the continued reductions over time around 2030 actually begins to reduce the overall supply within the energy system despite ever-increasing demand. Now, what does this mean in terms of opportunity, which is what we're here to discuss? Around $4.3 trillion of new investment in zero emissions technologies. Now, I apologize for the US dollars. It's one of the pitfalls of working in a US company. I can exchange that for you later if you'd like. But the big message that we see outside of the total investment figures, around 3.5 trillion of this primary investment will go into new renewable generations if systems are to achieve the lowest cost way or design to meet the energy requirements of the markets that they're in. Now, bring it slightly closer to home. This is our view on the Australian mix going forward. Now, again, this is without any new policies coming into effect, and really, again, what is the lowest cost way and what are consumers really doing to interact with their energy consumption? Now, again, a few key messages. The first is Australia is a postcard for the rest of the region. The investment lessons that we're seeing, the technology changing, and the rapid rate already means that renewable energy are the lowest cost forms of new capacity to enter the system and are already beginning to undermine the operations and the economics of the existing coal fleet. Now that will continue, and we expect, again, a doubling, so 116 gigawatts of new capacity to enter Australia between now and 2040. 81% of that will be in renewables or battery capacity. Also, an interesting note is over this time frame, we expect around 46% of the total capacity in the year 2040 will be behind the meter, driven by the residential market in no small part, but also commercial and industrial consumers as they look to mitigate their exposure to very volatile energy systems and also environmental risks. And the result is an $88 billion investment opportunity in zero carbon, specifically renewables across the country, which is 76% of that will go into the renewable supply. So what formulates these charts? And I'll try to touch on these just briefly, aware I don't want to hold too much of the limelight from the rest of the panel. These are three very small but very powerful messages, which you might have seen before, but for the uninitiated, these are the learning curves or the experience curves of PV on the left, wind in the middle, and lithium-ion batteries on the right. But essentially what they mean is, for PV, module prices fall by 28% for every doubling of manufacturing capacity around the world. Now, we have long-term historical data to prove a 99% reduction in overall costs since the 70s, but looking at the other technologies, we see very similar learning rates, although slightly less aggressive. A 19% reduction for wind and a 90% reduction for lithium-ion. Now, what do these mean in terms of the interaction with the energy sector? This is one key note, one key point that we would note for what renewables are currently doing and that will continue to do in the future. This is the tipping point, which we see around the world, but bringing it closer to home, that over time, new renewables will be cheaper, if not already cheaper, than fossil fuel supply for a new build basis. Now, it's already happened in Australia, but very closely we see key markets such as China, the US, and parts of Europe following the exact same story. Now, this has been known for a while, and I think many people in this room would not necessarily be surprised by this event, perhaps by the timeframes. But the one we find much more exciting, and one we've seen and discovered recently, is that a second stepping point or tipping point begins to occur when new renewables become cheaper than the existing fleet. So simply shoveling coal to boilers is more expensive than building new renewables on a lowest cost basis, not risk adjusted, over certain timeframes. Now, the rest of the picture, just for completion, is that we see lithium ion continuing this trend over time as well, even though it's not a generation source, and we expect prices to fall from it by 75% from the current rate by 2030. Now, the 273 right now and 73 in the future, we didn't do that. That was a result of the figures, even though it does look slightly dubious. So putting these together, this is one of the mentalities or one of the pictures that we try to paint for what energy systems of the future will have to look like. Right now, it's quite common to accept that baseload and peaking supply make up the generation mix with low-cost fuel, particularly coal, and then more expensive but more flexible gas and other balancing technologies will begin to come into it. But with the cost of renewables over time and the drive from consumers and policymakers, eventually what we think the systems will have to be and will have to form towards is low-cost variable supply and highly valuable balancing technologies over the system. Now, these might come from the conventional or well-known ones such as gas, but increasingly over time, batteries, demand response, consumer behaviour, and flexible demand will be key, valuable, and well-supplied sources of energy if systems are to be provided and served on their least cost basis. So this is the diagram of what we say is the undermining or the tipping point of coal or inflexible supply. This is the Australian mix, but this message is really held true throughout when you enter markets with high levels of renewable penetration, which is the existing coal fleets simply aren't flexible enough to deal with low-cost variable renewable supply. We've seen this recently and we'll continue to see it in the future where the minimum levels of generation during peak periods of production and also the ramping capabilities during variable periods is simply insufficient and actually is a liability to the overall system and its operation. So to take a broader context in looking at coal, looking at carbon and the impacts of coal, we see that China will continue to be the dictating factor in the overall coal consumption trend. We expect coal consumption to peak in around 2026 or possibly before, but this is without any new policy, driven by China, and also importantly, over time, India and other Southeast Asian countries where demand is still growing at a rate that the other areas such as Europe and America haven't seen for a period of time, and Australia is a very good example of that, will dictate the overall consumption profile. Now, we see the overall dip towards the latter part of the year for a number of reasons. The first is primarily, as I mentioned, the cost of renewables are so low, they undercut the need for new coal supply for any new demand sources. So to take a more holistic view about where we place and to come back to the opportunities as we see them, we tend, and we admit to this and we have a chance to prove it, to be the most bullish forecaster of the role of renewables in the future. And this is without a wish list, this is without pausing towards global carbon emission constrained environments or targets. This is simply based on our view of the fundamental cost of some of these technologies. Now, we still stand by this for a number of reasons, but first to put in what are our findings, we see that the business as usual case from this least cost perspective is still lower than the NDC's currently admitted or legislated for the global power sector emission trends, but still significantly lower than a 2-degree scenario would require from the energy sector, presenting a fairly significant climate policy risk within the market and the industry. But we've been in this game for quite a period of time, and in the 5 years that I've been forecasting the uptake of renewables, I have to change my forecast every 3 to 6 months, but not once have I had to downgrade my expectations for the market. And this is a lesson we've learnt around the world in basically every energy system. So this is a comparison of our most 2 recent forecasts, 2017 and 2016 shown in blue, and other key providers of forecasts, WEO and the IEO, over time. So the big message in terms of opportunity, apart from the ones I've already highlighted, is we forecast the market, but yet we have always underestimated the pace of change that we've seen and we continue to expect to see. Now, I think that's me hogging it enough, so I'll pass it on to Richard. Thank you very much. Please don't steal our stuff from our lawyers. Thank you.
I'll save you the slides and just chat about what the CEFC's done. So I imagine a lot of you are familiar with the CEFC, but by way of background, our target or our objective is to catalyse investment into the clean energy sector. We're a federal government-owned organisation. We've been through a process, obviously, as you'd expect, in determining our investment strategy over a number of years since our inception. And that's bounced around to some extent, given the environment that we've been operating in. But one of the things that we've done over the course of the last 24 months is consistently look at science-based targets to deliver net zero carbon by 2050. And the purpose of that was really to try and examine those sectors in the Australian economy where it was most worthwhile us seeking to be active and to try and generate change and to try and crowd capital in, because we are seeking to try and crowd private capital in wherever we can. The total balance sheet of the CEFC is $10 billion. We've committed approximately $3.5 billion of that to date. And so even if we were to go out and blow $10 billion, we're seeking ideas to do that, so please let me know. We won't by ourselves be sufficient, clearly, to achieve the change that the Australian economy needs, so it is very much about crowding other capital in. So when we went through that process, we sort of approached it both from a top-down and a bottom-up perspective, but I suppose I'll cover off on the top-down perspective because it's most relevant in the context of the zero carbon economy. We worked with a number of different data sources and points of view, and so we're not holding this out as being the definitive view about what needs to be done or the investment targets, but we did work with a number of counterparties and data sources like Bloomberg, like ClimateWorks. And really what that identified for us was there are a number of sectors that we needed to focus on. There are some that are very obvious, clearly, so stationary energy generation, but also a broader set of what constitutes renewables and what we would refer to as grid infrastructure, so pumped hydro, clearly, batteries, obviously. Transmission and interconnection is really important to facilitate greater renewables penetration. And there are a number of other factors associated with that grid design that we're interested in. So, for example, smart meters to facilitate behind the market penetration, which as Leonard said, is very important. Apart from that, there were a number of industry sectors that we focused on where we thought that there were significant opportunities based on factors like proportion of emissions in the Australian economy. So to give you the list, if you like, so property across a pretty broad spectrum of what constitutes property, infrastructure, agribusiness, social, I'll call it community housing, agribusiness I've mentioned, manufacturing and industry were sort of the key sectors that dropped out of that work. Now, each of those have got different degrees of complexity in terms of how you need to engage, and each of them have got different stories about what the investable opportunity is, but all of those are quite important if we're seeking to try and get to the targets we need to. On the slightly more difficult end of the spectrum, again, possibly from those, there's transport and biofuels, and I should have mentioned bio waste as well in the renewables section. So those are the key things that came out of the work that we did. You then have to consider how you're going to try and invest in those sectors, and some of them are much, again, as you'd expect, some of them are relatively straightforward, some of them are more complex. We try not to take an unduly restrictive view about how we want to invest in those sectors, because the reality is we have to be flexible enough to work with the key counterparties in those sectors to try and achieve change. Some of them have different characteristics. Agribusiness is incredibly diverse. Transport, depending on how you view it, probably less so. So there's quite a different approach that we've taken in each of them, and we have the capacity to deploy different products, so that's a luxury which possibly not all investors, well, obviously not all investors have. So we can invest all the way through from venture capital, early stage pre-commercialisation, seed funding, all the way through to traditional senior debt, and we've done things in all of those sectors. So we have flexibility around the product. It's fair to say, and this is another point that probably needs to be considered carefully in the light of the feedback from investors about the lack of investable opportunities, it's fair to say that you have to work pretty hard to try and find where on your risk spectrum those different sectors can make sense. So without wishing to generalise, is it highly likely that, for example, agribusiness investment is likely to have a different risk profile to the next industrial scale wind or solar? Yes, it is. And so it's not as simple as looking at your preferred credit position and just trying to pick off where you can get things done in that sector. So we've had to be pretty flexible, and I think that's a key message for all investors to keep in mind and when they're looking at the totality of the task. I'll leave it there other than just to note some of the examples of some of the variety of different things that we've done. So we have deployed funds across a range of different types of transactions, and some of my colleagues will probably curse me for missing their deals, which they think are interesting or sexier than others. But the ones that have been of note lately, we put $15 million US into a Nordic bond issued by a lithium mining company because the supply chain for batteries is clearly critical, and that's well within our mandate. We've put $20 million to work on a peer-to-peer lending platform to try and create a retail green loan product that mum and dad investors can also participate in. We've done obviously quite a range of green bonds, which Michael will talk about more later as well. And then there's been clearly a full spectrum of participation in the wind and solar market, both industrial scale and certainly for solar behind the grid. So look, those are probably the key learnings out of the process that we've taken. Flexibility, targeting particular sectors that are key sources of emissions, and just thinking long and hard about the preferred point on your risk return profile, rather than necessarily we haven't been able to afford ourselves the luxury of sitting back and waiting for deals to come to us in the in the shape that we'd like them.
Thanks, Richard. Have we got my slides, or we've? Thank you. I'm going to start with a bit of an opening gambit, as opposed to an introduction, and just we'll use the word green and green bonds. Just point to the pie chart above me. You can see there that green bonds represent 1% of the global bond market. The numbers there are tiny relative to a $90 trillion market, but I don't think, if we don't take the challenge of green bonds, and that's what the gambit is, and we don't take it seriously, if we are going to be able to achieve a net zero carbon economy, we need to very much focus on where the opportunities in financing are. And this is where green bonds become quite critical. So by introduction, I'm Michael Correa. I'm part of the Westpac Institutional Bank. My role is the origination and distribution of capital markets products, amongst a number of other things that I'm involved with. So I sit on with Michael Chen and a number of other people at Westpac on our climate change committee, and we're very proud of the work we've done to date. And I just wanted to touch on quickly what Westpac's action plan is, and we've refreshed that in April this year. If you haven't got it, there's a book on your table called the Red Book. We come from green to red, but Westpac is red. But in terms of covering off what we are doing with an action plan, and I think from our approach to climate change, we did a lot of scenario analysis prior to the development of this action plan, and that scenario analysis was based around the current outlook for investment of climate change solutions, which is required to achieve a credible pathway to a net zero emission by 2050. So we've taken a very long-term view. I just want to point out a couple of those key points around the action plan. You'll see it on page 5 of the Red Book. We increased our target for 2020 financing from 6 billion to 10 billion. Inclusive of that 10 billion, we've also committed to facilitating 3 billion worth of green bond or capital market transactions around the green bond opportunities. Then looking at 2030, we increased our target for financing to $25 billion for lending as our overall target, in mind that we are looking at a 2015 opportunity. So that's something we're very proud of. I think today we stand about $7 billion of financing of green opportunities. So that's Westpac's position, and I do encourage you to take a look at that when you've got some time. But just moving to the bond market, and this is something that I've spent nearly close to 30 years of my career focusing on. And I'm going to kind of differentiate between what's happening globally and what's happening in Australia. 2007 was the first green bond issued, so we're actually 10 years into a market, even though we're in its infancy and we're at less than 1% of the total bond issuance in the market today. But as I said before with my opening gambit, having an efficient and functioning capital market, especially around, my view, fixed income and solutions around issuers for both issuers and investors is critical for the success of this strategy. We have made progress. As you can see there, $900 billion of climate-aligned, or green, but climate-aligned bonds have been issued to date, of which around 220 are designated to be green. So that's a great start, and we can very much work harder towards increasing those numbers. The range of issuers that we've seen in green has substantially increased. Initially the green bond issuers were predominantly focused around government. That would be semi-government, supranational, and sovereign issuers, and that's mainly around senior paper. We're now seeing corporates and broader issuers looking at green solutions in their capital market strategies, which I think is a great initiative that we can hopefully grow this less than 1% to a much bigger number. And the other side of the equation is we've also increased the size and tenor of transactions. You can see the column chart on the right-hand side, on the left-hand side of this chart, seeing the growth in green bond issuance in the Australian market over time. But also, what that doesn't tell you is the tenor of these deals has also increased as well. 2017, we've hit close to $2 billion in issuance, which I think it's over 5 deals, but is something that we at Westpac we participate in and are very proud of. So the other side of the equation with any capital market is also the investor, and what we've seen is a movement, and Australia is a very slow adopter here, I must say, but we've seen a movement away from just a designated green investor to an overlay investor, and also just normal bond investors buying green instruments. So this broader range of investment appetite will help fuel this demand, and we're seeing that as a big part of where we're going. So I'm seeing a big appetite for green in the Australian market, even though the numbers are very, very small. So I'm going to leave it at that, because I do believe we'll probably have some questions about what potentially the bond market is, and hand it over to Michael, and then hopefully we'll get some questions later on.
Thank you, Michael. Last speaker on the last panel on the last day. I feel the weight of it on my shoulders. Very glad to see you all here, and very excited to talk about this part of the panel, which is going to refer to research and strategies that are being used today to achieve a net zero carbon economy, or help to get to a net zero carbon economy. My name is Michael Salvatico. I'm with MSCI SG Research. To give some background to those people that I haven't met, MSCI is a New York listed company that has a large index business with $11 trillion tracking the main indexes. Part of what MSCI does is an analytics business and an ESG research business. In that ESG research business, we're looking at all sorts of environmental, social, and governance issues that companies face. And today I'm going to be talking to you specifically about those that relate to climate risk. We have 170 analysts that are working on this. We cover more than 8,500 companies. And in doing so, we provide investment solutions to a large number of organizations globally, over 1,000 clients. Michael, can I grab that changer, and I'll see whether I can do this, or whether I've got Bill Hartnett's eyesight. No. Very good. So we've got 3 slides today that we're going to go through which cover the different areas of net zero carbon economy. We're going to look at some low carbon solutions, some sustainable impact metrics, and some green bond standards. So this is looking at it from the perspective of listed markets. We've heard some private equity or private unlisted market solutions, some green bond solutions. We'll cover a little bit of that in the 3rd slide. I've taken this framework, which is a way for you to think about your investment strategies, all your investment strategies, in a recently published paper, How Resilient Are Mutual Funds to Low Carbon Transitions, published in September 2017. There's a couple of hard copies out the front for you. What this framework provides you with is a way to look at your investments through 2 axes. The low carbon transition risk, which is made up of carbon intensity and carbon reserves, so fossil fuel reserves, versus low carbon transition opportunity. And that's where we're looking into the revenues of companies' operations from the perspective of energy efficiency, renewable energy, pollution prevention, sustainable energy solutions. And you'll see there that if you're tilting your portfolio towards the bottom right-hand corner, you are in the asset stranding section and at high risk, as compared to top left-hand corner, where your low carbon transition risk and high carbon transition opportunity, looking at a potential upside. We take the research that we use to analyse the 8,500 companies that we look at when we do this analysis, and we've constructed a number of indexes. In fact, there's over 700 indexes that we prepare as standard indexes. The ones that I'm referring to, though, are the Low Carbon Target Index, which is designed to reduce the carbon emission exposure by 70% and the fossil fuel exposure by 90% in your investments, while at the same time having a similar risk-return profile as the market cap weighted index. Now this index is actually used. I mean, I invest in it personally through an iShares ETF. I have access to the US stock market, hooray, hooray. But you could get access through it today, for instance, through Vision Super, who have shifted their passive equities to the MSCI Low Carbon Target Index. It's designed to do that. It's designed as a replacement index. Now you might say, how's this getting us to a net zero economy? Well, it's not providing the same solutions that you would in a 2-degree scenario, for instance, which is at the moment a theoretical scenario. There's a lot that goes into it, a lot of uncertainties. But what it is doing by giving you that 70% reduction in carbon emissions is achieving the kind of goals that Paul Atkins talked about when he released his paper in 2015 in the Nature Journal that said, in order to reach a 2-degree target, we need to keep underground 82% of the coal that we currently know about, 50% of the gas that we currently know about, and 33% of the oil that we currently know about. And that was based on 10 years of research that he did at the UK Energy Centre, Research for Energy Centre. So again, these strategies are pointing us in the right direction, getting us to that net zero carbon economy. The other index that I want to talk about is referring more to the opportunity side here. So this is where we look at companies and we analyse their operations and determine where their revenues are coming from, those environmental or in fact social benefits. We have an index called the Sustainable Impact Metrics Index, which is designed as not as a replacement to a core index, but as a high conviction index. There's only 92 companies out of the 2,500 in MSCI All Country World Index, which have greater than 50% of their revenues coming from one of the categories that's in the social or environmental opportunities. The benefit here for investors is that the environmental and social opportunities are linked back to the Sustainable Development Goals. So you're also achieving your targets from that perspective as well. That same research that goes into sustainable impact metrics can be shown here in a portfolio level analysis. And I'm just going to talk about the bottom part of this slide, the environmental impact themes, because we are here referring specifically to net zero economy. And you'll see here that in a portfolio of $1 million, because we know the revenues, the portion of revenues that these companies are generating, we know how much you've invested, we can actually determine that here 63,000, a bit more than 63,000, is providing alternative energy solutions, 128,000 providing energy efficiency solutions, and so on. And this is the kind of research that Talia referred to this morning when she was referring to UniSuper's investment solution that they've brought in-house, which previously was a global environment index that MSCI has as a standard solution. I want to bring up one of my current favourite quote at the moment. This is a bit of a side, but related to this. Has everyone seen Avatar? Hold up your hand if you've seen Avatar. Yeah, you probably all saw it 8 years ago. I only just saw it coming back on the aeroplane from the UNPRI. And there's a scene there where Neytiri turns around and says that all energy is borrowed and that someday we have to give it back. And if you think about it from that perspective, quite deep and quite meaningful. But what it means is if we're using coal for our energy now, future generations are going to have to give back a lot. And so if you have an investment and you can look in this is listed equities. If you can look in your listed equities and say, well, a large part of the listed equities that we're invested in are providing alternative energy or energy efficiency solutions, then maybe you're helping solve that give back problem. Finally, I want to refer back to green bonds. We started talking about green bonds right from the very beginning when we had ICBC talking about the green bonds that they were providing for the Chinese market. And that's a massive ask that they have in China. There's over 300 billion green bonds that they have to issue every year for the next 5 years as part of that 5-year plan. One of the things that we see with green bonds is the uncertainty around what that green bond represents. And so 4 years ago, MSCI got together with Barclays and created a green bond index, green bond standard. It currently has around 120 issuances. It captures about $80 billion in green bonds. And what's important, I think, is that it's using these principles, these guidelines to ensure that each of the bonds that's captured in that index meets these minimum requirements. And in my discussions with investors, I found that the green bonds have become more acceptable. I mean, if you hold your hands up now, if you have green bonds in your investments, I'd be interested to see who has some exposure to green bonds. Okay, we have a few. Who had exposure to green bonds 5 years ago? Right, we're down to one. And I'm glad that it's Bill who holds his hand up, because it's actually an example that comes back to LGS Super and the work that Bill did with Omega Global Investors that comes to my mind when I think about green bonds, because they put together an ESG sovereign fund 5 years ago that included green bonds, and I thought that was great. When I asked them how it was going and how the discussions with investors had passed, what feedback they had, this is 5 years ago, they said to me everyone loved the idea, except when they got to the word green bonds. And then they went, whoa, if there's green bonds in there, we're not so sure about it. I think when you have that discussion today, that investors are a lot more comfortable with green bonds, and that those kinds of solutions, as we see from the evidence of people putting up their hands, are part of the investment solution that is helping us get to a net zero economy. Thank you.
Thanks, Michael. I'm just conscious of time, so I have a few questions, or a few general questions I'd like to put to the panel, but I'd like to open up, invite the audience to ask questions. So I'll try not to take up too much time. So what I've heard is there is investable opportunity out there, and there are channels to access it in both public markets and private markets. In the case of immature emerging technology, there are options like innovative forms of piloting and partnering with organisations, entities such as the Clean Energy Finance Corporation, and it would be, if we had more time, it would be interesting to talk about, you know, what more could be done with that and how investors could, you know, look further into that option to actually sort of jump in and get started where otherwise they would think it's just not viable. So the question I want to put to you all is, what's still holding everybody back? And perhaps, Michael, you could talk a bit to the, you know, what will it take to get more uptake of the equity strategies and solutions? And hold on, Michael, before we start talking again. And I'd invite Michael Correa to talk about, you know, the green bonds. You know, we've still got it's a fraction of the green bond market, especially in of the total bond market. And Australia is a fraction of the global green bond market. And although institutional investors are sort of getting their head around this more, what's it going to take? If you'll just indulge me for a few minutes, I think there was one slide that you, Rebecca, you were going to put up. Anyway, if you'll indulge me, I just put together a sort of a quick and dirty overview, and it's pretty rough, and I'm not going to go through it in detail, but just an attempt at sort of capturing what are some of the challenges or the barriers that I've heard talked about over the course of this conference, and whether they're real or perceived, and tried to sort of, you know, suggest some of the practical things that investors could be doing. But I guess, you know, as it stands, there seems to be a prevalent view that for a mainstream investor that doesn't have a sort of overriding green investment mandate or ethical mandate, they still feel that they are constrained by their investment mandate, by their fiduciary duty, by the sole purpose test and how that's currently interpreted in terms of how far they can go right now. And other than so it seems that, you know, they could continue to, is it the case that they'll continue to be constrained using the lever of policy construction in terms of policy positive investments, unless and until we see one or more of the following things? And what the obvious one is more advocacy for better policy, and the other main, beyond that, questions that I've been asking myself is, you know, at the heart of it, is this a valuation problem? It's about internalising future positive, negative impacts on assets into our risk and asset valuation modelling, and the market sort of pricing that in. In the absence of, you know, fast progress on policy and tools, does it come down to boards of funds needing to take bold and potentially, arguably quite risky positions in terms of long-term sort of strategic tilting or hedging positions? And there are various sort of forms of that we've heard about. Or finally, you know, is it the case that what it will really take is a mandate change or reinterpretation, and is actually that the most effective and efficient place to start? And I should actually just add the caveat that that's not the CBUS position, or that's just me with my moderator hat on, and just throwing that out there for people to respond to. But so I'd be interested to hear your thoughts, the thoughts from the panel on that, or is it just a case of we just need to look harder, work harder, and get on with it?
I can kick off. I mean, I think clearly, you know, there's limitations on how much harder any given person can work. I could probably work harder, I'm sure. But that's always positive. I think, you know, if I had to make an observation, and I must admit my comments are somewhat coloured by my previous life, which was selling, you know, structured debt to institutional investors in the fixed income market. So I ran the securitisation origination bond desk, amongst other things, at Westpac working with Michael. I find that the Australian market, at least as far as fixed income is concerned, is somewhat inefficient insofar as getting a read between the end ultimate investor's real desires and translating that into choice of investment. So there's definitely a groundswell of support for ESG investment. I think there's a very strong support for trying to tackle climate change, and yet so many steps with such patchy coverage and such sporadic, embracing of that issue. When you talk to the broader investor market, there are some outperformers, most of whom are probably in this room. But I do find that is always a challenge. It's a heavily intermediated market. There's inevitably going to be inefficiencies. I think trying to spend some time thinking about product design, process, communication to overcome some of that significant intermediation would be time well spent to overcome some of those challenges. There's probably other things that I could note. We're always up for a bit of partnering, which is on the slide, so please let me know. But I might just leave it at that.
Yeah, I'll just add to it. I think, well, we've got to actually look back and say, actually, we've achieved a lot since we've started this. It's not as if we haven't achieved a significant amount to get to where we are today. And whether we like it or not, and a lot of new products that come to market do take time to season. And seasoning means experience that both the issuer and the investor has to say that is successful. And I think to date, look at both the issuer and the investor experience around the green bond market actually has been very good. Investors have generally performed well out of their portfolios, and investors have had a good option in terms of their financing opportunities. That being said, there are still barriers, and the barriers that we still have are well known. It's not as if we don't have as many sectors we'd like issuing green bonds, and I think that's something that we need further verification around different sectors we can open up to. At the moment, we're predominantly around, well, let's call it really construction and building, and a little bit around renewables in terms of sources. We haven't moved into other areas, and that's the obvious places we can look at are agriculture or forestation is one place. With batteries and different sources, renewables, and then really what are we going to do with, say, for instance, vehicles and ABS around that category. And that's the other question with investors, really opening up their portfolios in terms of greater allocations. We talk about dark green versus light green investors with regard to investment mandates, and being able to say, are you going to have a specific only green mandate and have a significant investment pool that goes with that, versus the lighter green, which is this overlay product. I'm great to see that there are non-green investors buying green bonds still as well, but the depth is probably something we need, the underlying investor to drive their asset manager to say, actually, we want to have more participation, and we're actually motivated to be to see this as part of our investment portfolios. So we know what the barriers are. There's other I think kind of more minor aspects of what we're doing, but I'm actually quite pleased we've actually achieved a lot. I'd like to set a target that is significantly higher than where we are today. I talked about, we had the discussion at the committee at Westpac, and I'm probably part of the minority who felt that we were a little bit soft in our targets, and I'd like to think we can overachieve and actually gone beyond what we've actually set ourselves. So if we can take that attitude, I think necessarily by our lead, hopefully see where we can see the change occur.
Thanks, Justine. When it comes to listed equity markets, I think it's just a matter of time. I mean, there's a long list of investors who've already decarbonised their portfolios. Matt Winneray from New Zealand Super spoke on the panel yesterday, and we worked together with New Zealand Super to create a custom solution that meets their exact needs. But it achieves a significant reduction in carbon emissions and a significant reduction in fossil fuel reserves. So you don't have to you don't have to go overseas. I mean, as I said, coming from the UNPRI last week, surrounded by European investors, it did revitalise me in terms of the action around climate change that's happening in Europe. But you don't have to point to Europe to get those examples. It is happening here in Australia. In terms of why hasn't it already happened, I don't think it's a lack of conviction. I mean, you can't sit at this conference and sit on your hands and think there's not enough information. I mean, the example, I think, of, you know, if you were the colonel in an army and you had a 98% chance of an ambush, would you keep going down that road, or would you reconsider your path? I mean, if you listen to the science for climate risk, climate change, it's comparable. And so I spend a lot of my time now speaking to boards about climate risk and educating them on what's available, and sometimes that has to start from a very low perspective. And sometimes there's some pushback. You know, one of the things that we didn't have on that panel session yesterday, which I think is a great idea to have that example of a board meeting, is we didn't have the skeptic saying, this isn't climate change that's causing this problem with this road. You know, this is ridiculous that we're bringing up climate change. Because I think that's probably representative of what happens on some boards. And you have to have a very strong argument to confront that.
I'll probably jump in on that as well. I suppose I'd take a slightly different lens to it and raise 2 points. The first is, as you've listed, look harder, work harder is certainly a component of it. But I wouldn't undersell the value of general innovation. I mean, the conversations we're having today and the investment strategies that are being rolled out right now are certainly not what were in place in the conversations 2 years ago, 2 years before that, and 2 years before that again. And they won't be the same in the future. So the risks and perspectives of the market are continuously changing. It certainly requires work, but how hard is that work, and how much should it be shied away from? Well, when I think it's just the general progression of what we see and what we do. And the final point, and I'll make it fairly brief, is to consider the value of the partnerships and the role of investment. Looking specifically at energy, obviously the common question is, what about energy, or how is it changing? One that I think gets missed out a lot is say, why energy? What is the purpose of having energy? And it's really down to the end consumer having a purpose, having a role, and having a value production from it. And so in a lot of the risks that we're seeing moving forward in the environmental space is worn and shared by the consumer. Right now we're seeing an emergence of, say, corporate PPAs, particularly in the US, but also we're seeing sort of a budding market in Australia right now, who are aware that they share the similar sorts of risk profiles from the return basis that the investors do as well. Both on the energy procurement front or just the environmental exposure, be it carbon or be it others as well. So the value of those partnerships will be key.
Great, thank you. I'd just like to open it up to the audience. I'm just getting a signal from Emma that we're out of time. So I'd like to thank the panel very much for a great discussion on this topic. And